Hey everyone, welcome to FinTech. So the stock market is down substantially over the last 2 months, and chances are, unless you're a short seller, you've lost money during that time. And with my portfolio mainly made up of high growth technology stocks that are introducing new services that will change the world, those have been hit even harder, with some stocks in my portfolio dropping 50, 60, even 70% since November of 2021. And this has led a lot of investors in these kinds of companies to either move money somewhere else like value stocks or to panic and sell out completely, oftentimes selling at a loss if they bought in at the top previously. So in this video, I'm going to offer my thoughts on the current growth stock market crash, as well as what companies I'm investing in going forward. While it's unfortunate that my portfolio is down over the last couple months, the best thing I can do is figure out which stocks I think are going to perform the best over the next several months to bring that number back up. So hit the like button if you want, and let's start by just talking about the stock market in general. Now, if we go to my Charles Schwab portfolio and just pull up the year-to-date change, just in the month of January, which is only 21 days old at the time I'm filming this, my portfolio is down $53,000, which is around 24%. That is a huge drop. And look, there's no way to gloss over it. That is a big loss for my portfolio. And I would have been better off completely selling out of my positions at the peak on November 7th and then rebuying in at this current time. But I didn't do that because I don't have nearly that much confidence in myself to time the market. But one thing that I can take some comfort in is that over the past 2 years, my portfolio is still up over 100%. Now, Charles Schwab says this is 270%, but that also includes money I added into the portfolio. So if you take that money out, it's actually up around 111%. Now, as far as where I think the market is going to go from here, I really have no idea about macroeconomic predictions. The stock market could keep going down, and we could even start to see value stocks being affected, like banks and manufacturing, in addition to the high growth technology stocks that are already being hit. Or we could see a rebound when uncertainty around inflation and the Fed kind of clears up, problems with the supply chain clear up, and maybe the issues in China become a little more clear, and that results in growth stocks, or at least technology stocks, that are creating new value to absolutely launch up in value. It's hard to say. But as far as my thesis in my companies, for the most part, has not changed. Yes, they are down substantially from where they were a few months ago, but that's just the price of the stock. I think the underlying value of at least most of the companies is still there. But there are a few exceptions to that, which I'll talk about a little bit later in the video. Now, I know I've seen some comments on my channel seeming to imply that I wouldn't show my portfolio because it was down, but no, my goal with these videos is to be as transparent as possible. So let's just dive into my stock positions right now and start going through them from the largest to the smallest. Now, the first position in my portfolio, which is still the largest position, is Datadog, which as of this point is worth $52,000 off a cost basis of $35,000. So despite the huge drop that we've seen, it's still up around $16,000. Now, the fundamental thing with Datadog is it benefits as companies generate more data. It provides tools to enterprises where they can view their applications, their security, and their infrastructure all through a single pane of glass. So the more complicated data from companies get, and the more they move to the cloud, the more that benefits Datadog. And we've seen Datadog maintain an extremely high growth rate and high margins while maintaining a relatively cheap price compared to other companies even on this list. Next up, we have CrowdStrike, which is still my second largest position, despite the fact that I've sold out a little bit of it over the past couple months. In fact, if we look at my Patreon and look at the trade alerts that I issued one on January 6th where I sold 35 shares of CrowdStrike, and then I issued a second alert on January 12th where I sold an additional 79 shares of CrowdStrike. So that's around $20,000 out of my CrowdStrike position, which leaves me now with around $25,000 left in CrowdStrike, about half of what it was before, and that's off a cost basis of $30,000. So this looks like I lost money in the company, but that's also because the way Charles Schwab calculates cost basis is on first in, first out. So basically the shares that I bought at the lowest price several years ago, I sold, and the shares that I bought more recently at a higher price are still here. So that's why that looks like a loss, even though I did in total make money on this company. Now, the general thesis around CrowdStrike is that they have the best security product in the world for cloud companies, and that as more companies move to the cloud, their product is going to get more and more use. And we have seen them accelerate the number of customers signing on to their platform and the amount of revenue they generate each year. But as CrowdStrike has gotten larger and larger, their percentage increase each quarter is starting to slow down. So they're starting to just become a victim of the law of large numbers. And so I did decrease my position in this company a little bit. That being said, I still like this stock. I still think they have a lot of room to grow. I just don't need them to be quite as large of a percentage of my portfolio. Up next, we have Cloudflare, which, if you've been paying attention, has dropped dramatically over the past few months. In fact, from its peak, Cloudflare Cloudflare is down around 56%, so more than half of the value in this company is gone. Now, I still own around $24,000 worth of this stock, and that's off a cost basis of $17,000, so I've still made money in this company despite its ridiculous drop. And this doesn't even tell you the full story, because I actually sold some of my shares in Cloudflare just before it hit the peak. And I told you during these reviews at the time that I didn't really understand why Cloudflare's price had gone up so much. If we look at the stock price here, it went at one point from around $100 a share to as high as $217 a share. And honestly, this whole run-up right here didn't really make sense to me, so I'm not surprised that it gave up those gains. But if we look at the price from, let's say, September 2021 until now, it's down around 33%, and that seems to more closely mirror other stocks in my current portfolio. And I've talked about Cloudflare a ton on this channel. Its basic goal is to become the next AWS or Azure or GCP. And while a few years ago that might have seemed ridiculous that a startup could start competing with Amazon in terms of hosting websites, Cloudflare is actually getting through there. The other big thing with this stock, and I think the reason the market likes it so much, is that they've maintained a 50% growth rate basically every quarter for the last decade, which is essentially unheard of. After Cloudflare, we have ZScaler, which is a security company. ZScaler I currently own around $15,000 worth, and that's dropped from $16,500 when I first invested. So this stock I do have a small loss in. This is kind of the start of my mid-tier positions where I don't have quite as high confidence in them as the top 3 largest positions, but I think they will still do well going forward. ZScaler is an expert in zero trust security. So in a traditional security model, you would basically set up a firewall around your entire network and hope that everybody stays out. But once they got in, they could basically access anything they want. ZScaler makes it so that every single thing that connects with something else has to be authenticated. This kind of technology is really where all companies are moving as they move more of their infrastructure to the cloud, and so ZScaler is going to play an important role in that kind of enterprise security. After that, we have a brand new position in my portfolio called Sentinel One. Now, anybody who's been watching this channel for a while knows that I actually did a comparison video between CrowdStrike and Sentinel One a few months ago. And Sentinel One has a very similar product to CrowdStrike. They too offer cloud-based security to enterprises, but up until recently, I wasn't a big fan of the company because their margins were so much lower than CrowdStrike's despite having a similar growth rate to a younger version of CrowdStrike. Well, their margins have started to improve, and in some cases, they've even managed to win customers that were competing with both them and CrowdStrike away from CrowdStrike. So that shines pretty favorably on that company. Now, Sentinel One, I currently own about $11,000 worth of, and that's down a little bit off the $13,000 initial investment. But all of this investment basically just came from selling some of my CrowdStrike shares and diversifying it into Sentinel One. After that, we have ZoomInfo, which I currently own just under $10,000 worth of, and that's down around $2,500 from just under $12,000 initial investment. Now, ZoomInfo makes it easy for salespeople to connect with the people and companies that they're trying to sell to. So it works for the salespeople because they don't have to go knocking on doors, and it helps the people in the company who are actually looking for a product that those salespeople are trying to give to them. ZoomInfo's still been a rock-solid grower. It's not a super flashy company, but I enjoy having it as just kind of a middle-sized position in my portfolio. After this, we have Upstart, which has had a lot of ups and downs over the past couple months. Now, currently Upstart is down to around an $8,000 position in my portfolio, and that's off a $22,000 initial investment. So in total, it's lost $14,000. Now, this one obviously needs a little bit of explaining. So if we pull up Upstart's stock price, over the past year, in around March of 2021 up through November, it had a ridiculous run-up of 610% over that time. Now, I bought in at several points along that curve. I think I bought some in May, and then I bought some, I think, in July, and maybe even a little bit in August. Now, I sold out a bunch of those shares after the initial drop in November of 2021, after it showed their growth was slowing dramatically from what they had reported a few quarters before. Now, again, like I've talked about, because Charles Schwab uses first in, first out to calculate your capital gains, that means that the shares that I bought at the cheapest price, I've already sold. And so I'm pretty much left with the shares I bought on the way up to the peak in the price. Now, Upstart, I do think got a little bit ahead of itself. I honestly think around $200 a share was probably fair for this company at its peak, and yet it got all the way up to almost $400 a share. So I do think the market was ahead of itself there. That being said, now the stock price is down below $100 per share, which I do not think is a reasonable amount for this company. Now, Upstart's core technology is in providing AI for offering loans. Traditionally, in order to offer a loan, you have to evaluate someone's credit based on a credit score, which is just one number. Upstart replaces that with an AI model that can use thousands of different parameters to more accurately predict someone's risk profile. So you can either offer better rates to good borrowers, or you can offer loans to people who traditionally wouldn't qualify for a loan. Now, even though Upstart's stock price has dropped a ton, it's not because their product doesn't work. It does, and they've continued to sign on more and more partner banks over time. Fundamentally, I do believe this technology will change the world. It's just going to take a while for the stock price to figure out what it wants to do. And I'm betting that it's going to figure out that it wants to go up. After Upstart, we have CRWD, which I currently own $3,500 of, and that's off an initial investment of $5,600. So it's down a little bit under 50% overall. Now, CRWD is really three companies in one. You have their gaming business, you have Shopee, their e-commerce business, and you have C-Money, their financial services business. CRWD I was originally very interested in based on the speed at which they were growing, but I never felt comfortable making it too large of a position because of their position in the e-commerce space, which I know can be brutally competitive when you're competing with people like Amazon and Alibaba. That being said, CRWD has been called the Amazon of Southeast Asia, and at this point, that moniker is starting to become inaccurate because CRWD is also expanding into Mexico and Brazil and potentially some other countries soon after that. CRWD is definitely a long play for me, probably longer than most of the companies in this portfolio, but I'm okay still keeping a small position in that company. And then to round this out, we have three companies left, which are Amplitude, SoFi, and Affirm. Now, for the most part, these are just companies that I want to keep on my radar to decide whether or not I want to make them larger positions. Amplitude in total has dropped around $800, Affirm has dropped around $1,200, and SoFi has dropped $600. So of these three companies, I'm probably going to grow one of them into a full-size position and then sell out of one of the others, and I'm not sure which at this point. But if I had to guess, I would probably sell Affirm out of this list right now. The thing is, Affirm is a leader in the buy now, pay later space, meaning you can check out on a website and choose to pay over time for your item. The issue is, this is generally very bad for the consumer, and the kind of people who use this service are using it to buy things they can't afford with money they don't have, which as someone who's very into personal finance is completely opposite to everything I believe in. Affirm also claims in the mission statement to be trying to benefit the consumer, which doesn't make sense with their business model. And so that disconnect there has always led me to keep this as a smaller position. And even though the company's numbers did look pretty good, I don't know if the numbers tell the full story here. And if I had to pick one stock out of this list to grow even larger, at this point, it would probably be SoFi. Now, SoFi I've made several videos of on this channel, and they're essentially a fintech startup that is now starting to become a full-on bank. They were recently approved for a bank charter, making them one of the only fintechs in the country that has that approval. And between their three different businesses of financial services, their Galileo technology platform, and their lending business, SoFi really has the ability to capture a millennial or a Gen Z consumer at a relatively young age and just grow with them throughout their life as they build wealth. Unlike a lot of other fintech companies like, say, Robinhood from a few months ago, SoFi has had a relatively reasonable valuation, I feel, over their lifespan, with a little bit of weirdness because of the fact that they were originally launched in a SPAC by Chamath Palihapitiya. But as the company gets more and more mature, I think that they're looking more and more impressive, and yet their stock price isn't really reflecting that. So I think that this potentially is a good opportunity to get in. And that is even after the stock is up around 20% over the last couple of days because of the announcement of their bank charter. Though I wouldn't count on them holding on to those gains in the short term, as I talked about in my video talking about the bank charter. Now, one last point that I do want to bring up is that there's a fundamental difference between investing in companies that you understand and you believe in and just investing in companies based on hype. Now, I know a lot of people think that these companies are overhyped, and yeah, maybe some of them are. But I do believe as long as you have a good reason for investing in something, you can outperform the market over time. Now, what defines a good reason, in my opinion, is what you do when times are bad, when the stock is down. It's easy to have high conviction in a company when everything's going up, but it's a lot harder to pick winners when everything seems to be going in the toilet like it is right now. Honestly, this just gives everyone, including me, a good opportunity to take a good hard look at their portfolio and figure out which of these companies do you actually want to own and which ones are you just holding on to for nostalgia's sake. And based on how well you're able to figure that out, I think that's going to determine your portfolio performance over the next 2, 5, and 10 years. But let me know what stocks you're investing in right now and what kind of pain you're feeling in the stock market right now. I've got a feeling it's hitting most of us right now, and it would feel good to know it's not just me. And right now, WeBull is offering you 3 free stocks when you deposit $100, so if you're trying to get some kind of green in your portfolio, that might be a good way to do it. Don't forget to like and subscribe, and I'll see you next time.